Rookie of the Year, and in his second full year, he became Prudential's #1 investment advisor in Canada. Mike has consistently ranked amongst the top advisors in Canada ever since. The merger of Prudential and London Life in 1996 provided Mike with the opportunity to create his own independent operation, Langlois Financial Services. Mike is a certified senior advisor and has achieved lifetime member status at the $1 Million Roundtable. Membership in this organization represents the top 1% of life insurance and financial services professionals worldwide. Please welcome the President of Langlois Financial Services, Mike Langlois.
Well, I need to take care of my technical information and products first. Are we all set there, Chris? All set to go? Tonight I'd like to take the rest of our time that we have here. As a matter of fact, I think I made a mistake. See? I'm not the technical guy, Brian is. All set now? Okay. Everybody hear me? I'd like to take the rest of the time we have here this evening to talk to you about some of the things that I think will help you to succeed in the investment market. Fred's been kind enough to give us some of the technical information. I'm going to give you some of the more direct, basic things that we can handle and things that we can do. But before we get started, and you don't need as much time to memorize it because Fred helped me out there, so we have to do that as well. So we okay to move on beyond that now? Okay. Now, you know, some of the things when you talk about investing in the investment market, you know, there's a lot more to it than just choosing the right stock and picking that perfect stock, because even the perfect stock can let you down sometimes. And a good example of that is Research in Motion. That was one I could think about because almost everybody knows the company Research in Motion. And if you don't know it, you certainly know their product, being the BlackBerry. So here you have a company that's got great outlooks, good profits, fantastic product, known worldwide, and yet they still weren't immune to the downturns in the market that we've recently experienced as they dropped over 40% in just 2 weeks. That's why diversification is so important when we're talking about investing. And we created this little slide here I wanted to share with you because it does a couple of things. Two things people worry about the most is diversifying their investments. And the second thing is, and you hear it more from seniors than you do from younger people, but not having all your eggs in one basket. That's what I hear a lot. You know, Mike, I don't want all my eggs in one basket. So what we have here is we have two investors. Portfolio A was set up by an investor who had some money to invest. He wanted to be diversified, and he also wanted to make sure all his eggs weren't in one basket. So he took his money, broke it down in 5 parts, and delivered it to 5 different investment firms. Told them to invest his money and to diversify it, and not to put his eggs in one basket. That's what he was hoping to do. The second investor in Portfolio B, what he did was he went to an advisor like myself and said, Mike, I want to diversify, and I don't want all my eggs in one basket. Can you help me out? I said, sure. Now, they look the same, but when you take a little closer look at these portfolios after they've been invested, what happens? Well, it turns out that the individual that took his money to 5 different institutions didn't accomplish anything because all the eggs in one basket he was worried about, that's exactly what he got. No diversification, as most of the money was in bonds. And a big part of that reason was because he separated his money and gave it to 5 different firms, none of them were communicating each other. None of them knew what they were doing, you know, what the other individual was doing. So inadvertently, it all ended up in one thing. The other side, he succeeded quite nicely because he gave all his money to an investor, like myself, and said, here's what I want. So I knew exactly what he wanted, so I was able to take advantage of different sectors of the market, also different world economies, and make sure that all of his money wasn't in one basket. So that leads to the next part, which is dollar cost averaging strategies. And I know that Fred touched on it a bit, but dollar cost averaging is something we've been really trying to hammer home with our clients for years. And a good number of you have taken advantage of it, and I commend you for that. But we still have a good number of people that choose to buy their investments once a year at the same time every year. Now, that works out okay, provided that every time you buy it, the market's on a downslide. But reality says that's not the case. In a good number of situations, you're putting all your money in when the market is elevated. So what does that mean? In the long run, you're generally increasing the average share price that you pay, and therefore at the end of the road, you make less profit. Where dollar cost averaging comes in to help you is that you invest the same amount of money, but you break it up, say in 12 equal installments each year. and you put that money in January, February, March, right through the year. By doing that, sometimes you're going to pay more, but other times you're going to pay less, and it's going to lower your average cost per share. By doing that, your lower cost average per share means you're going to have more money at the end of the road. So it's really, really important that you understand this for those that aren't doing it. We just created this slide to give you an idea of what we're talking about. Portfolio A represents a lump sum invested at the beginning of a theoretical volatile time in the market. And Portfolio B represents the same amount of money being invested periodically over the same time in the market. You can clearly see at the end of the slide that the individual taking advantage of dollar cost averaging has a significant advantage over the person that wasn't. Another thing we have to consider is reducing our taxes. And as Canadians, we don't have a lot of tax breaks available to us. The average Canadian really doesn't. The only one that's very easy to use and everybody knows about are our RSPs. But unfortunately, there's so many people that don't use RSPs. And I really have a hard time getting my head around that because I don't understand how people would rather pay more taxes rather than save for themselves. But it's a fact. There's billions of dollars in unused contribution limits that people haven't used. And for those of you that aren't buying RSPs, or if you have children that maybe need to understand better the advantages of getting into RSPs, I just want to explain the basics of it. It's simply taking a little bit of money out of your income and investing it in an RSP. Because you're doing that, the government's saying, hey, this guy's trying to save for his retirement, let's give him a tax deduction. We're going to give you a tax deduction based on your tax bracket. So basically, the more money you earn, the higher tax bracket you're in, the bigger tax deduction you're going to get. Now, that money can be used to create an emergency fund, as Fred talked about, or it could be buy something you wanted or pay down debt. There's lots of things you can do with that extra money than pay taxes, I'm sure. Another thing you can do to reduce your taxes is invest in labor-sponsored investment funds. Now, these funds, they're a great source of lowering your taxes because they do a little different than what RSPs do. RSPs give you a tax deduction. Labor-sponsored funds give you a tax credit. And you can deposit into a labor-sponsored fund up to $7,500 a year. And that, if you did that, it would provide you with an additional $2,625 in tax credit. Now, when you take that amount of money and add it to the deduction you get with the RSP, it's a significant amount of money. You can do a lot with that. Now, labor funds are a great portfolio diversifier, and they're a really good investment. And, you know, back in the first stages of labor funds, I guess the first generation of labor funds, they didn't really do so well with their investments. And part of it could be lack of experience and maybe lack of places to find to invest the money in that they were collecting from the investors. But the investors didn't seem to mind too much because they were so caught up in the tax credit. They were just so happy getting all these tax dollars back, they didn't pay attention to the return. But after a while, everything comes full circle, and you know, some people got tired of always seeing that it was having a negative effect on their portfolio, so they kind of shied away from them. Well, I can tell you, the new generation of labor funds are very, very different. We're in a whole new world with regards to that. And if you look at them, they are a great source of investing. And we have a couple of good examples of this. If you take a look at the Venture Link Brighter Future Fund, it's returning 19.6% year ending September 30th. And then there's also the Covington, which just blew the doors off it, with 30.4% rate of return September to September, ending September 30th. That's not bad in any market, never mind a repressed market like we're in. Now, you also have another new item that's come on the market that you can deal with is the new tax-free savings account. Now, this doesn't give you a tax break or any deduction like you see with the other items, but what it's done, what the government's introduced, is an account where you can invest up to $5,000 a year, and any growth on that money is totally tax-free to you. Now, the way I look at it, anything I can do that can earn me income that I don't have to claim on my income tax, that's a pretty good investment. I'm in. Now, also, life insurance can give you tax savings benefits if they're set up properly. And that's something that if you want to know more about it, just give us a call and we'll explain to you more in detail what that's all about. Now, here we are getting all these tax credits and reducing that and kind of improving our bottom line for, you know, available cash. You need to consider reducing your debt. And I think all of us know that, you know, we've always been raised to say, you know, debt's bad, you shouldn't be in debt. But we also understand that if you want to get ahead in life, you've got to have some debt. And, you know, less debt, though, means more disposable cash for you. And there's different kinds of debt. And we've seen what happens when you have irresponsible borrowers and irresponsible lenders in the marketplace. It almost brought the economy to its knees. It might have for a couple of days. But you need to grade that debt. And when I say there's different kinds of debt, well, for example, you get your mortgages. And mortgages are generally considered a good debt because you're buying something that you know is going to appreciate in value, and it's going to be an asset that you'll be able to use down the road. And it's a good thing. What I consider bad debts are things like don't pay till 2010. I mean, what they're really saying is we hope you can't pay in 2010, because then they're going to flip it over to their financial department and charge you 20% interest, and that $1,000 couch is now $4,000. And the same thing with credit cards. You'll be paying 20, 21%, maybe more. And these types of things really get a hold on you, and it's really hard to dig yourself out. So I would strongly recommend that you would pay down those types of debts as quickly as you can. And what you could do is maybe buy RSPs and use labor-sponsored funds, those types of things, to reduce your taxes and save for your future, and at the same time take that money and pay down your debt. Wouldn't that be perfect? The thing is that, let's face it, I mean, there's probably a lot of people thinking, you know, come on, Mike, I'm at the end of my rope. I can barely make the payments. How do you expect me to buy RSPs, let alone pay down my debt? Well, if you're in that type of situation, then maybe you need to talk to us about consolidating your loans. Now that you've learned that all these different debts can be a real problem, bring them all together. We will put them together, reduce the payment for you each month, and at the same time, be able to free up the pressure from you, and that's going to give you a lot of disposable cash and lower your cost of borrowing. Investing, you know, into RSPs and using the tax credit to reduce your debt, I think, is just an awesome idea. Assessing your risk. I know we talked about that a little bit. I believe most of the people in this room, their risk tolerance is well matched with their portfolio. But if for some reason that you're concerned and the market's really taking its toll on you, then, you know, you can go to our website, answer our risk questionnaire, and that'll give us a score that we can use to determine what your actual risk tolerance is. And then we can align that with your portfolio. If it matches up right, great. But if it doesn't, we'll get in touch with you, we'll sit down, and we'll make the necessary adjustments to make sure that it does match up. The only thing I ask you when it comes to things like our risk assessment is that you got to answer it accurately. We're asking for general, you know, they're general questions asking about generally how you feel about the market as a whole, not how you feel today because it was down 500 points. You know, your risk tolerance doesn't change every day. So we want to have some sort of a roadmap as to how you feel in general. So if you just take that mindset when you're completing it, that'll help us a lot and it'll be more accurate for yourself. Being properly informed. Fred talked about this as well. Well, I'm talking about it a little deeper because when I think about it, you know, 30 years ago, well, some of you weren't even here 30 years ago when I look around the room, but for those of you that were, I can remember, you know, internet was something from a space, you know, I mean, it didn't exist. We had maybe 2 local newspapers, and we had 20 channels, and if we were lucky, we had cable TV with a wired remote control. So we didn't get a lot of information, and we weren't really inundated with things that happened every day like we do today. Now you got, what, 300 channels? You got the internet, you got radio, you got God knows how many newspapers, and you're getting information everywhere. And the problem that we're having is that all these guys are trying to sell you on their product or their station or their channel, whatever. They all want you to watch them. And they're not really worried about how informed you are. That's not really high on their list. They're going to say and do whatever they have to do to get you to watch their show, even if they scare you to death. And the problem with that is when you're getting half the story, you might make some very poor judgments with regards to your investments when you're not informed, and that's going to cost you for years to come. So for those of you that don't really care about what's going on out there, like the guys I met on my holiday, then just carry on. You don't even need to waste your time watching these shows. But for those of you that feel that you need to be informed and you want to be more involved so you understand what's going on out there, then go somewhere where you can get proper information. And I'm using our website as an example because we have market updates there regularly. And they're being provided by top experts from some of the top investment fields in the country. And if you want information, go to the people that are going to give you the facts so then you can better be prepared to make an informed decision. As Fred said, some of the best investments are in volatile times. And I really truly believe that RSP season's now. It's not in February. That's how I feel. And for those of you that are still buying in lump sum, you want to seriously consider buying your RSPs sooner than later because Here's your one sure chance of buying it at some of the cheapest prices you'll ever see. That's just what I believe. Now, it sounds easy. Oh, market's down, prices are cheap, I got the money, let's buy it. But the problem is that every time markets get volatile, the more volatile they become, the more emotional we get. And logic ends up out the door. So that's why that investments are the only thing that people own, that they're prepared to sell at a loss and buy at a premium. That's a fact. And the example of that is GICs. You see a market drop 25%, someone says, my God, I just lost 30%, I'm out of here, I'll go protect myself and buy a GIC. And while that GIC is going towards maturity, you're watching the market recover and start going up. And when that GIC matures, you go, you know what, I really like this ride, things are all better. And guess what, the guy jumps on the ride at a premium just in time for the next correction, you know. And then he throws his hands up and says, why can't I win in this market? Well, you know, emotion's a real funny thing. It's a pretty powerful thing. And I know we talk about it very seriously, but Brian and I found a couple of comics that we thought would be kind of fun for you to read. One of them's our long-term investor. We all know this guy. I've decided to hang in for the long term, maybe even all day. And then we have our emotional shopper. Hi, I'm an emotional shopper. I was wondering when the sale will be over so I can make my purchase at full value. Now, you know, we chuckle about it, but the truth is a lot of people have ruined their portfolios just because they haven't got any guidance and they're panicking. I recently received an email from one of my clients, and he's a producer at City TV, and I really liked his email because it was very short, but it said so much. So I asked him if he'd mind if I used it tonight at the seminar, and he told me to go ahead. So let's have a look at it. Let's see what it said. It says, hey, Mike, how you doing? So I know intellectually that we should be okay as far as our funds go, but with the whole Merrill Lynch, AIG, and Lehman Brothers thing happening today, and the Freddie Mac and Fannie Mae bailout 2 weeks ago, a slight desire to gently place all my money in a shoebox and barricade my doors is threatening to emerge. Any words of wisdom? And, you know, I laughed when I read it at first. But the reality is, who hasn't felt like that this year? It's been a tough year. And I think we've all felt really, you know, throwing our hands up and saying, what are we to do? Well, anyway, I called this client, and I told him, I said, how can I help you? And he says, Mike, I'm losing it. He says, I don't know what to do. Working in a television channel as well, you're hearing everything. People are talking. I don't know whether to get out, get in. I don't know. So I told him, I said, you know what? There's really only 3 things you need to ask yourself. The first thing is, do you have a good advisor that you trust? And he said, of course, you know that. And I said, well, are you properly diversified? He said, definitely. Do you take advantage of dollar cost averaging as much as you can? He says, certainly. I said, then relax. You got nothing to worry about. The only other thing you can do is wait. Because we're in a downturn, we will come out of this. You're doing everything possible that you can. And if you continue to do these things and stay the course, you will always win. You just have to wait it out. He turned around and said to me, he says, you know what, Mike? He says, that's why I contacted you. He says, because I just needed your voice of reason to keep me grounded when I was starting to lose it. And, you know, I've said this before. It's so important. This just proves how important your relationship with your advisor is. Someone that you can trust and someone you can depend on. And I'm not just saying it because I'm an advisor. I really believe that because he's going to help you stay the course when you're starting to waver and maybe thinking of making a decision that could hurt you long term. And that leads to the next thing, which is communication. And communication's always been a very important part of your relationship with your advisor, but I truly believe now it's more important than it's ever been. There's different forms of communication. I mean, there's face-to-face meetings, of course. At Langlois Financial, we always promise we're going to meet with everybody at least once a year to review their portfolios, answer any questions, or deal with any changes that might have happened. And the way we do that is at the beginning of every year, we mail everybody an RSP. We call it our RSP letter. We got names for all these things. But it's our RSP letter simply because we send it at the beginning of the year. And that letter just basically welcomes you into the new year, tells you a few tips of things that you need to consider and do, and then it reminds you that we're going to book an appointment to sit down to review your investments, answer any questions you might have, and discuss your RSP contributions for the upcoming year. Now, that doesn't mean we're only going to meet with you once a year. We will meet with you as often as we have to when it's convenient for you. And if it takes 5 meetings in order for you to feel comfortable with the decisions you make, hey, that's what we're going to do. And, you know, to us, that's very, very important. The next thing is telephone contact. I mean, you know you can contact us from 8:30 to 4:30, Monday to Friday, until 8 o'clock on Monday nights, You're going to talk to Peggy or Brian or myself, and we're going to answer any questions or book appointments or whatever is required. We've also keep our cell phones numbers on our business cards so you can get a hold of us at any time of day or night, 24/7. We mean it. And the reason for that is because there's a lot of times, I mean, you can't plan when this nagging question or an emergency is going to come up, or you have your next anxiety attack about your investments. Could be Sunday at 7 o'clock at night. Give me a call. We understand. Don't we, Charmaine? We understand, right? We get, not that we get a lot, we get a couple. You know, the other thing about telephone that's very important, recently I spent, you know, because of the markets, and I feel so connected to you, you're my friends, you're not just my clients, I felt the obligation to try and call every single person on the phone to let them know what was going on and maybe take off some of the stress off their backs and try and, you know, keep them grounded, so to speak. And it was amazing how people responded. I mean, I got so many emails thanking me, and my God, I mean, you guys were supporting me more than I was supporting you, and I was really touched. It was really something to me, I tell you. So telephone's very important. We also have our website that we put a lot of time and effort in, and we really believe that's an important communication tool. Things like our LFS reports, our quarterly newsletters that go out to everybody that sign up for it, you know, answer questions about topics like CPP or home buyers plans, just to name a few. And if you've missed some of the articles we've written, then you can go back in our library and look up anything you want to answer the questions that you have about these different topics. Now, we've also recently started, well, you know, also I forgot mentioning market updates. I talked about that before, but that's another thing that you can do going on our website and check those updates. If you want to be informed, that's the place to go, believe me. Accessing your accounts, you can do that from our websites. And for those of you that are already signed up for that service, you can look at your mutual fund accounts or your seg fund accounts anytime you like. For those of you that haven't signed up for it and think maybe you might like to, I just need to let you know that right now the seg fund side is available for new sign-ups, but the mutual fund side is being updated, and it probably won't be available until about the middle of November. We'll let you know when that happens. We've also recently decided that, you know, when important things happen or maybe big changes in the market, we should send occasional emails to keep up to date with people. And we've sent 2 of them this year. One we sent in the spring and one we sent in the fall. And it covered topics such as coping and taking advantage of volatile markets, for example. And if you didn't receive it, or you didn't bother reading it when we sent it to you and you just clicked junk, I don't know, and now you decided you like those emails, just let Peggy know on the way out, and she'll be sure to email it to you tomorrow. Now, communication is great, and in order to make sure everyone gets the important information that we're trying to put out to you, we need your help. And if you look in your little folders, I don't expect you to do it right this second, but in your folders, there is a little contact information sheet there. And it's asking you from everything from your name, address, phone number, work number, cell number, email address. We really want all that information, and I would really appreciate it if you give that all to us before you leave tonight. Now, if for some reason you don't want us to have your work number because you can't receive calls, or you're retired, or you don't have an email address, don't leave it blank. Just write in the reason why you're not giving us the information so that we don't keep asking you for it, and we update our system and say, well, we don't have their email address because they don't have an email. Client events. A lot of you have been involved in a lot of our client events. That's a good way to communicate with people as well. And we have lots of them throughout the year, a lot of different ones. Tonight's is an educational one, and that's to help keep you informed, make you understand what's going on out there, because people really don't worry about what they know. What scares them is what they don't know. So the better we can prepare you and inform you, the less likely you are to make a mistake and get away from your investment plans. We also, a couple of years ago, started RSP weekends, and we do a couple of those during the RSP season, where if you come to our office, we will provide you with donuts and coffee and a nice glass mug or a travel mug. It's yours to keep. And you also get to choose a prize out of our treasure chest, and it could be something really nice or something small, but you won't leave empty-handed, and you'll certainly have a good time if you come to visit. We have other social events that we do from time to time, and our next upcoming social event will be on February the 5th, 2009, when Langlois Financial is very proud to be presenting David Cassidy live at the Rose Theatre. And this is going to include dinner. Yeah, that's the Partridge Family's the whole thing. So I know some of you guys know who he is. And this event is for anyone who's referred a client to us in 2008 and the first month of 2009. They will be invited to this event. It's our referral appreciation night that we do each year. It's just our way of saying thank you. As I've always mentioned in the past, and every time I see you, there's only two ways that we can make this business grow and continue to do the things that we like to do for you. And that's number one, if there's a product or service that we provide that you can make use of, we'd appreciate if you give us the chance to serve you. And secondly, if you know somebody that you know can benefit from what we do, please tell them who we are, because this way, not only are you looking after yourselves and us, you're making sure that your friends and family are getting the same quality service and advice that you've been accustomed to receiving. Now, in closing, I know we've had you here for a while. I want to thank you again for coming. You don't know how much it means to me that you take the time from your busy schedules to come and stay here and for a couple hours with me, and we have a nice dinner and talk a little.